Hello and welcome. Today we'll be talking to Jenna Barnard, who is the co-fund manager of Henderson Diversified Income Trust. Jenna, thank you for joining me today. Now, investors will read a lot in the media about the end of austerity, another financial crisis around the corner, the doom of Brexit and Trump's trade wars. So I want to know, are these narratives important in your world? And what else could investors be looking at?
I mean, these events are important if they go badly. But by their nature, they're quite hard to analyse and quite binary risks. I think bigger picture, what drives our asset allocation and our investment is where we are in the bigger business cycle and economic cycle, because this has been 10 years of markets recovering. Strong performance in fixed income markets, riskier areas like high yield credit, financial bonds. Basically the higher yielding, more equity sensitive parts of the market. So what we think about a lot at the moment is how late cycle we might be and what are the risks going forward in those parts of the market. Obviously, if Brexit goes badly or the trade war with China goes badly, that will potentially exacerbate any downturn that may already be in the offing. But from my perspective and John's perspective, and we've been concerned all year about how late cycle this looks in markets, and credit spreads have already started to turn. So in particular in investment grade, where credit spreads bottomed in February of this year and have been widening most of 2018.
And when you talk about credit spread movements, how does that translate to how you manage the portfolio?
So credit spreads beginning to widen basically means the yield on corporate bonds is going up relative to government bonds. So corporate bonds are underperforming government bonds. The difficulty in 2018 is not only have credit spreads widened, but government bond yields have been edging higher, particularly in the US, less so in other countries. So that double whammy is quite difficult for bond investors. As the yield goes up, the price of the bond goes down. And as I said, it's a difficult environment, but it's pretty textbook late cycle. 2007 was a similar year where credit spreads and government bond yields went higher. And then 2008, you make money in government bonds and lose money in credit. So in this environment, it's very difficult for a bond manager. All we can do is maintain discipline, lend to good quality companies. If anything, get even more rigorous in terms of who we lend money to. So we've been chipping out a few financial bonds in recent months, not because of bad results from these companies, but just that's a very high beta area of the market, and the relative value didn't look particularly attractive to us. So it really is about discipline and preparing ourselves for more difficult times to come. And I think we've been pretty cautious all year. John did a piece which said winter is coming a few months ago, which people thought was ridiculously bearish, and we got criticised a lot of this year actually for being too cautious. But obviously with the equity correction in October, the oil price coming off, some of the very poor economic data coming out of Europe and China, that narrative I think is beginning to come home.
Now, we've all heard that it's been a testing time for bond managers in recent years. So what is your take on global bond markets right now, and why would you invest in fixed income?
It actually hasn't been a testing environment in recent years. Only in 2018 has it been difficult as a bond fund manager. The surprise, I think, was how low government bond yields were for years to many people, and how tight credit spreads were. So actually, last year, the year before, were very good years for this company, and it's 2018, as I said, that double whammy of government bond yields edging higher, and credit spreads particularly going wider, that have been difficult. So the narrative around bonds has been negative for years. I would agree with that. But actually 2018 is the first year where that's really come to fruition. And as I said, for us, that feels like a classically late cycle environment, very normal. And so our concern and our thought in recent months has been about how late cycle we are and when a bigger turn may arise.
And finally, what kind of activity can you report on regarding the Trust portfolio in 2018, and what can shareholders reasonably expect from the Trust in 2019?
We try not to be too active in the portfolio unless we have to be. In corporate bonds, you do get new issues coming to market. There's a kind of natural cycle of new issues, but that's been kind of less than you would expect. Companies have stopped refinancing debt to the extent they were. There's not a huge amount of private equity activity. So the new issue calendar hasn't really driven many changes to the portfolio. As I said, we've reduced a few financials, increased a bit of investment grade, but to be honest, we're not trying to rejig the portfolio. We've been pretty cautious. We've had this late cycle narrative for about a year now. So in a way, we've been preparing ourselves, and it hasn't caused a readjustment in the portfolio in the last month or two.